Hey, what's up guys? It's Ryan Mallory. Want to talk to you guys today about market volatility and how to trade it. Trading market crashes, big market sells, big market upswings. How do you get to where you can profit consistently in these kinds of conditions? What can you do to not lose all your capital when the market volatility is crazy and unpredictable? I'm going to talk about that today, give you some quick steps on how I handle market volatility and crazy price action on a daily basis. Let's get one thing straight though. Rarely is a market sell-off straight down. It just doesn't happen that way. There's going to be dead cat bounces in between. Maybe you'll get 4, 5, 6 days of selling to the downside, but you're going to get some dead cat bounces in between that's going to make you question whether or not this sell-off is actually done and over with. One of the best things that you can do is when the market's selling off or when the volatility and the price swings are really crazy and you're seeing a lot of gaps and you're just really not sure what to do, you feel like you're chasing after a trade or you feel like you're chasing after a certain move in the market, the biggest thing is just don't trade. Don't chase after it. That fear of missing out, that'll get you almost every time. Don't do it. You don't want to be adding a ton of positions to your portfolio. That's a huge mistake that people make, is that they get confident that a bottom is in, so they'll start getting into highly leveraged ETF plays, followed by some very volatile small cap plays and some other trades, and they get really excited because they think, okay, this is the bottom, I'm going to make a lot of money. That's not how you do it. That's the recipe for disaster. And what's going to happen is that the market's going to go right back down, and all of a sudden you're going to be bag holding all of these extra stocks and all these extra trades that you should never have gotten into in the first place. So if you're unsure about the direction, don't trade. If you are going to trade in a particular direction, do it in small increments. You don't have to get all long or all short all at once. Which brings me to my next point, and this is important. Book gains aggressively. Raise those stop losses as much as you can. Don't let a good dead cat bounce go to waste if you're long when the market decides to finally turn lower again, because you're going to lose all those profits. Just yesterday, the market was going down and it decided to bounce back up. I got taken out of my SPXU trade. I decided to book those gains aggressively and take a 3.5% profit on that particular trade. Had I not done that and held till today when it was becoming obvious that the market was reversing back up, I would have lost all of those gains today. Aggressively booking gains when things are in doubt and when things are looking sketchy and impossible for a reversal, whether you're short and the market wants to go long or whether you're long and the market wants to go back down again, you have to book gains aggressively. And here's the thing. If you miss a trade, if you miss an opportunity to get long when the market's bouncing or when the market's going down, don't chase after it. There's always going to be more opportunities. There's always another day of trading. There's always another pullback for you to get long bond or another bounce to get short on. But you don't have to go chasing after it. If you miss an opportunity, it's okay. A lot of us do that. It happens all the time. Just wait for the next opportunity. It's worth remembering that intraday bounces can really mess you up. Okay, now look at this here. This is just yesterday's price action. If you look here, we have a nice little intraday bounce. A lot of people got sucked in on that. I didn't trade it. I didn't go long on it. I held my short position through it. But look what happens right afterwards. Once it starts to make you think, okay, the longs are about to push this thing higher. No, it sells right back off, and then eventually it really smokes everybody before finally recovering into the close. But you don't need to get in on these kind of bounces. Another great example is back on August 12th, 2009. Market gaps way down, I mean, big time. And it starts to base and starts to push higher and even goes into the gap, and a lot of people get sucked into this particular trade. This was another big no-no. Markets don't bottom like that. Usually it comes on an extreme capitulation, and I'll get more into that in this video. But for the purposes of this particular point, know that these kinds of just false hope bounces are always going to lead to more downside. And here you go. People got sucked in probably at 290.30 on SPY, and where did it close out the day at? It was pretty bad. It was down into 280. So I mean, there was a lot of downside. 20 more points of downside on the S&P 500. One thing you don't want to be doing is trying to catch a falling knife. That's what we call trying to call a bottom without there really being any particular bottom in place. It's like, have you ever tried to catch a falling knife? I haven't, but I can only imagine how many times you get cut up trying to do it, and that's what the expression means. You go back to the end of July and the beginning of August, I mean, look at all the selling that we saw here. You have 6 straight days of selling, and a lot of people were thinking that, okay, we're bouncing off the lows here, I'm going to go long. And what happens the next day? It just pushes right back down again, and the day after that again. And then we're trying to hold the 50-day moving average. People are thinking, okay, this is going to bounce. We've already been down for 5 straight days. It's not going to go down a 6th straight day. The last time that happened was back in January. It just doesn't happen that much. Well, guess what? We gapped down big time the next day. And that's what I mean. There's a lot of problems when you're trying to just randomly call bottoms in the stock market. It's a great way of losing just endless amounts of capital. I've done it in the past. I've learned my lessons from doing that. I'm sharing these lessons to you because I don't want you to do the same thing. And when you get these kinds of sell-offs, you have to expect there to be a dead cat bounce. And that's what you get right here. Following the 6-day sell-off, you have 1, 2, 3 days of buying that makes people feel like that the bottom's finally in, but rarely does that happen, because what you really need is capitulation to the downside. And let me show you an example of capitulation. You go back to quarter 4, late December 24th, we were capitulating. And then we had a sell-off the next day that took us even below those capitulation levels. And then what happened was a huge flurry of buying happened. Now, what I like to use is the T2108 indicator. And this indicator gives you a good idea of the percentage of stocks trading above their 40-day moving average. When you get to like the levels of what we saw in December, that's this time when you want to start looking for capitulation to take hold. When you start seeing a reading of 3%, like what we were getting on December 24th, that is a sign that the market is about to bottom at any time and go on a incredible run higher. And what in January we had one of the best Januaries of all time when that reading reached. Now, granted, it can get down to the 5s and 6s and capitulate. It doesn't have to go all the way down to 3%. But once it starts getting into single digits, that's when you want to have your ear to the ground, because when it did get into single digits, it was within a matter of 3 days before the market finally bottomed and ripped higher. So check out the price action. We talked about how oftentimes price action can go straight up when there's a market bottom. Look at this on the SPY. When it finally did so, it went pretty much straight up. I mean, there wasn't many down days in between, but there was some down days that you could get back long on. I mean, you take the second day of the bounce and it gave up over half of its gains on the day. So you could have easily gone in and then rode the market back higher. But the key is watching this T2108 indicator that TC2000 provides, and there's a link on the front page of my website, shareplanner.com. And you can get a free trial of it. But check this out. I mean, this is some extreme readings, and it rarely do you ever see these kinds of extreme readings. You do see some that go into the 10s or in the single digits below 10, and that can also provide a good reading. But when you start seeing them get below 5, that is when you really know that a bottom is about to happen. Anything below 10, keep your eyes open. Anything below 5, know that it's very imminent. And that's where you get your capitulation. You get your capitulation when it just feels like the world's coming to the end for the stock market, that the market is going to cease to exist as we know it. That's the feeling that people get, that the market's never going to recover. And it's at those times where the market actually capitulates. You get a huge burst of volume to the downside. You're seeing huge chunks of price just getting ripped off of the S&P 500, off of the Dow. You're seeing 100-point moves in the Dow, 10-point moves in S&P in like a matter of seconds. And when that happens, you know that there's a lot of capitulation, there's a lot of volume, and the market's about to bottom. So this video isn't meant to give you this like concrete formula. It's to give you the warning signs and to give you an understanding of how to trade very volatile markets and how to trade it and trade it with success, and then to when to know when you should actually start dipping your toes back into the water and when to get long on the market, and to when to actually start trading with a little bit more confidence that the rally is going to sustain itself for many days, weeks, months ahead. Appreciate you checking out the video. I'd also encourage you to try out a 7-day trial of the Swing Trading Splash Zone. It's a great community of traders. You get all of my trades for the month of August here. It's been a huge blessing for not only myself, but for the traders in there too, to have people in there to bounce ideas off. I've been able to stay profitable throughout the month and to be able to help traders through a very difficult time of trading with my real-time alerts, my analysis, my trade ideas, my watch lists. I tell you where I'm putting my stop loss at, when I move it up, when I'm getting out of a trade, whether I'm long, whether I'm short. It gives you everything you need to be able to succeed and trade successfully in the stock market in the best of times, in the worst of times. Thanks for watching. I hope you enjoyed the video. Please be sure to like and subscribe to my channel, as well as check out some of these other cool videos that I've done. And if you want to swing trade with me each and every day, you can do so by going to www.shareplanner.com/splashzone. Thanks and happy trading.